In this video, guys, we're going to look at 10 rules for investing in a bear market. Stay tuned. Hey traders and investors, a very warm welcome to you. So bear markets come along from time to time. When they do, they are brutal. From a trader's perspective, you're an active trader, offer a lot of opportunity. For an investor, they can be more challenging. So if you're a trader and you have an investment portfolio, or if you're an investor, you have a portfolio or you're considering it, whatever you're doing, managing your own stuff, these are some ideas as to how you might better improve your performance in a bear market, or some things to bear in mind in a bear market as to how you might weather that storm a little bit better. Okay, number one, ignore the analysts and tips, right? These are just irrelevant now. People giving buy ratings, people giving tips, it's all sentiment. In a bear market, any kind of logic tends to go out the window, especially when it's in its full force. Selling is aggressive. People are selling not because they believe that stock or that market is a bad investment. They're selling it because they have to. They're selling it because the livelihood of their company relies on it. They've got a hedge fund. They're like, hey, listen, if this fund goes to X, we're out of business. If we cut it now, at least we can come back and grow and take a few years and come back into the game. Or whatever. People are selling stuff because the economy's struggling, they have to get cash. There's a different justification for why people are selling. So that comes to the kind of same thing of ignoring the analysts and tips. It might be the best value thing ever. It might be superb value. It might be a company might be doing very, very well, but it's still being sold. And it looks good on paper, but you know, it's emotionally driven selling. So just ignore those analysts and tips. And number two, look to defensive stocks. These are the kind of things that will weather the storm much better. They're not necessarily, they won't go down, but they're not going to go down as much as the kind of really good, strong stocks in a bull market. Those are the ones that are going to get pulled the plug first, because those are the ones that most people are in heavily on margin. Those are the ones that have to go out the door first. The slower, high-yielding defensive stocks are the ones that are going to possibly stay stagnant or go up or go down less than some of the higher, real aggressive kind of the technology type stocks, or whatever sector you're in at the time was a bear, or whatever the kind of favorite sector was when the bear market came in. So look to defensive stocks to kind of diversify, not necessarily putting all your assets in there, but just considering maybe reducing some of the holdings and moving and rotating a little bit into defensive stocks. And three, consider cash or hedging. So one thing, some of the great investors out there say, listen, just gets cash. When the bear market happens, just gets cash. Another, like Buffett, says, hey, you know, pick up value, but ride the storm. And actually, you know, even though the ignore analysts and tips is there, if we go back to, we'll go to that in a second, but number nine, thinking long term, if you can do that, then you're in a better position. But we don't want to be diving straight in. When the bear market starts, you think, oh, it's great value because it's moved down so quick. Generally, they're going to run for a reasonable long time and run further than you think they will. That's the biggest takeaway. So consider cash or hedging. Obviously, the best thing to do is not get damaged by the bear market. Even better if you can make money from it. So if you're going to pull out, put into cash, great, or consider hedging. So either taking a short position, maybe on a CFD, on an index CFD, or on a spread bet or something. It doesn't necessarily need to be the size of the portfolio, but something that maybe makes you some money as the market falls lower if you don't want to liquidate your stocks. Options, put options are generally going to be expensive by the time things get going. So you probably end up overpaying for stuff like that, although it is still an option out there, an option to buy an option, to sell an option, sell a call option or buy a put option. The other thing you could do is to buy an inverse ETF. So there are ETFs out there that make money when the market goes lower. They can be on the NASDAQ, S&P 500, Dow, specific sectors. If you buy one of those, you're going to make some money when the market moves lower, and it's going to offset some of your losses from your portfolio. Another thing you can do is kind of look to buy the volatility index, but by the time things are kicking off, that's probably already going to be spiked up. And number four, don't buy on margin. It's very tempting to kind of see bargains out there and want to scoop up a selection, say, oh, I like this stock, I like this stock, I like this stock. But if you're buying on margin and you get it wrong, you know, that stock could go down another 20% from there, still be a great buy. And unfortunately, if you've bought on margin aggressively over 5 or 10 stocks, you're out because it's magnified so much. You guys understand the concept of leverage and margin. So just be cautious about buying on margin. I say don't buy on margin, but be very, very cautious. If you're going to use it, then understand that, you know, hey, this is going to go down a lot more before it gets better, or it could potentially. Another thing is, margin changes. When things are kicking off, the broker has the right to say, hey, you know what? I'm changing the margin on these stocks. I'm changing the margin. I'm doubling it. I'm tripling it. I'm taking the margin away. And then you're in a position where you're forced to sell. You might have had a long-term thesis on it, but you're forced to sell because you haven't got the assets to cover the margin. So, consider not buying on margin, actually buying the physical stock itself. Number 5, be careful of falling into the selling is done trap. You see that quite a lot. Selling's done. The selling's done. That's the exhaustion move. The selling is done. 9 times out of 10, the wave will last way longer than you think. It's the same with both markets, isn't it, guys? Actually, bear markets are a little bit more emotional than bull markets. Well, a lot more emotional. But they always stretch too far one way. So even if you think you're right, likelihood is it will stretch further, just to squeeze out the last few people. Number 6, don't buy as soon as you see green days. Common trap this, made the mistake myself before in bear markets. You see 2 or 3 green days, you think that's it, that's the bottom. You buy and it's just literally short covering, it's selling, backing off, creating that liquidity vacuum. Buyers kind of getting excited, and of course, when the next leg comes and it rolls over, it's even more violent because they've got not only those guys stuck in, but you've got more from higher up. So don't buy the first bit of green. Have a structure, have a plan as to when you will buy. Number 7, most stocks follow the market. So don't be tempted to think, well, that's a really good company, really good stock. It doesn't matter in a bear market. It does not matter. It could be making so much money. It could be having a massive market share, ahead of the leaders, very efficient, all the kind of good boxes that like to be ticked from buying and investing in a company. If the market sentiment is weak, that thing will be sold. Okay, 8, selling bad positions. This is not a time to get stuck and in love with or married to positions. If it is getting hammered, the stock, and you can see that this thing is still going lower, then get rid of the position. You can always come back into it. Now, you've got to trade from a logical perspective. There's no point selling it right at the bottom of a bear market. But if we think you're coming into a bear market, things are getting hammered, there's consistent selling, consider dumping your worst performers. Consider allocating assets elsewhere, shifting around. Okay, number 9, think long term. So, if you're investing and you're in a bear market, you've got to say, hey, listen, I've got to be prepared for a decent haircut on this for a 5-year, 10-year view, because this could carry on for maybe 6 months, a year, maybe 2. How far into it are we? Okay, I might get a bargain. Maybe a couple of these companies might even go bust if I'm buying some kind of a bit more speculative stuff. But longer term, if I'm prepared to ride out the storm and I'm going to invest in companies that I believe have got a long term, they've been here a while, nothing's changing, they're making money. This is just purely from a kind of emotional perspective of the overall market. I think these will come back. Then thinking long term and not looking at day-to-day valuations. And the final thing, guys, number 10, consider scaling into positions. So you've identified a handful of companies that you'd like to invest in and pick up at good prices. Consider scaling into your position. So if you're allocating 10 grand into that company, 20 into that, 5 into that, 15, whatever it may be, however you decided to allocate your assets, consider splicing that up into tenths and say, okay, well, I'll put a tenth in week 1, and then in week 3, in week 6, in week 9, or month 1, month 2, or I'll put 50% in now, then I'll scale in the rest, whether it's higher or lower. So you kind of dampen the effect of trying to be right straight, because bear markets can be brutal. You can buy one day, a week later this thing is down another 10%, and you're looking across your portfolio and thinking, oh, that's pretty damaging. And what you get from scaling in is you take a core position. If the market goes up, you're okay, you're adding, you're still getting value. If it then starts going down, you're adding within a structured framework, and you're kind of reducing the cost of your investment. So it's not a bad thing to consider, guys, if you're looking to invest during a bear market. So those are 10 rules for investing in a bear market. Next one we get will be interesting to see what happens. And when you're watching the video, maybe you're watching the video now and we are already in one. Whatever you got to do, keep the risk managed. Make sure you do no major damage to your trading account if possible. Play defensive, but know when to get aggressive when the time is right. Okay, take care, guys. See you next one. Bye-bye.